welcome everyone who's just joined to our LBTT update. My name's Isobel D'Inverno, and I'll be joined this morning by Bob Langridge. We're going to be talking about a couple of aspects of LBTT. One of them is a recent case involving a group relief claim, and Bob's going to be talking about that. And then I'm going to be talking about transitional leases and how LBTT works with transitional leases. Please feel free to put your questions into the Q&A function as we're going along, and we'll try and answer them in the question and answer session at the end, or indeed as we're going through. And if there are any questions which we don't have time for, we will get back to you afterwards. And similarly, if you have any questions that don't occur to you during the presentation, please feel free to send us an email. I'm going to hand over to Bob now to talk about the recent SDLT case of Tower 1 against HMRC. Bob.
Thank you. So this is an SDLT case. It has some relevance to LBTT. There's quite a lot of detail in it. So what I would like to do, rather than really drilling down into all of it, is just sort of give you a feel for what actually happened in the case and what I think the key lessons from that case are, because I think they're important things for everyone. I'll try not to get too carried away because I think this is deeply interesting, and I know that there is nothing less edifying than a nerdy man nerding out at length. So, first of all, quick overview from this case. Really, I think there are several lessons from this, but the main ones I want to draw out are that when we are dealing with relief situations, we always have to be wary of targeted anti-avoidance rules known as TARs and general anti-avoidance or anti-abuse rules known as GARs. The precise wording of these matters, and they do vary across reliefs and different taxes. The general idea behind most TARs is that a relief is not available where one of the main purposes of a transaction is to gain a tax advantage or to facilitate tax avoidance. And the general flip side to that is that a transaction is okay for relief if it has bona fide commercial purposes, if what you are doing makes commercial sense. And one of the things in this case is that a bona fide commercial purpose can be overridden or polluted, I like to think, by other purposes that arise later. Another thing is that this case concerns a tax advantage that never existed, that never applied. And one of the interesting things about it is that it wasn't necessary for the taxpayers to actually gain a tax advantage in order to trigger an SDLT group relief TAR. So you can have a tax avoidance motive even if you fail to actually avoid any tax. And indeed, you can make things much worse for yourself just by having a bad motive. And as a general point, I would say when you're dealing with something complex like a restructuring is just being aware of mission creep, because really that's what happens in this case, is a taxpayer starts with a good motive, they become corrupted by a tax advisor and develop a bad motive, and ultimately this is fatal to what they're trying to do. Before we move on to discuss the case in a bit more detail, I'm just going to warn you now, there's a bit of audience participation at the end. I'm going to ask you a question, which is how much money do you think they should have paid SDLT on in the end? Should it have been none? Should it have been 30 million, which was the price paid for the asset in one of the series of transfers we're going to look at? or should it be 200 million, which was the market value of the asset at the time it was transferred? The reason why I'm asking that will come up as we go, but do try and bear that question in mind as we talk through this. The background, we have the Berkeley Group, who are a property development group. You can see a PLC with a number of subsidiaries. The taxpayer subsidiary that we're really going to look at is this one over to the right, Tower 1 Street George Wharf Limited. Now, Tower 1 was set up to develop a site on George Street in South London at St. George's Wharf. And the main development vehicle for the majority of the project was this entity at the bottom left, St. George South London Limited. This was quite a big development, and one of the last pieces on it was the development of a 50-story tower block. It had a relatively small footprint, full of residential units. And the developers decided quite reasonably that this was actually a very high-risk development for them. They had never done anything quite this big. 50 stories is very high because it had a small footprint and was in a risky location, you know, next to a couple of underground stations and on the riverside. They thought, we really wanted to ring fence this development risk. So actually, this final piece of the site, we want to build it out in a separate SPV. And that is Tower 1 St. George Wharf Limited. That is a perfectly valid commercial motive. And they also noted, well, actually, it would make it much more easy to fundraise for this tower block. It gives us a lot more flexibility about how we do it if we have it in a separate SPV as well. So 2 reasons why they're going to do a transfer. They went and they spoke to a major firm of accountants, who I'm not going to name. And the accountant said, oh, well, yes, you can do this. But in fact, there's another point here that you should be aware of. And that is, when you bought this site, the bit that the tower footprint is going to sit on was worth about 30 million. Now we think it's worth about 200 million. So there's 170 million pounds of increased value here. And really, that is going to be subject to corporation tax, but we can take that 170 million pounds of latent gains and we can turn it into a base cost. And the advantage of that is that when you sell the tower, you'll be able to deduct that base cost from your profits. So you will be paying corporation tax on 170 million pounds less. So the plan is to turn the uplift in value of this part of the site from a gain into a base cost without paying tax during the process. So here is what they did, and this is quite a high-level summary. The first thing they did is they grant a ground lease for a premium of 30 million base cost of the site to this company, Berkeley 64 Limited, and they claim SDLT group relief on that. Next, they transfer the entire share capital in Berkeley 64 Limited to Tower 1 St. George Wharf Limited. They do this at its market value of 200 million, but they do it in such a way that any gains can be sheltered in the shares of Tower 1, its now parent. And then next, they transfer the lease, again for its book value of 30 million, from Berkeley 64 to Tower 1 by way of a distribution. And they claim SDLT group relief on that distribution as well. So really if we just go back a slide, really what we've got here is 2 transactions, the acquisition of shares in Berkeley for 200 million and the transfer release out of Berkeley to Tower 1 for 30 million. Those 2 values representing the market value and the book value respectively. And the tax planning element here was really about how you recognize these transactions for accountancy purposes. We don't need to worry about it too much, but the general idea is for accounting purposes, we'll treat this all as one transaction, which is ultimately the acquisition of the lease. And we can treat that as 200 million, because in reality, that's the consideration you paid. Now, a key point about this, that will come up later is all of these transactions and all of these transfers all occurred on the same day, which not only supports the claim that it's all really one transaction, but also has an unintended consequence that peeps up later on. That's what they did. What they could have done, were they not planning to step up the base cost, is this: just granted a lease from St. George to Tower 1. That would have qualified for SDLT group relief. Yes, you would have had a base cost of 30 million for the asset, but that was the base cost anyway. And you'd have had group relief, and none of the following nausea would have happened. What did happen? First of all, HMRC contended, well, this tax planning exercise that's been proposed, it just doesn't work. It doesn't create a step up in base cost in the way you suggest. And both the taxpayers and the tax advisors accepted, okay, look, this plan was a busted flush. So this 170 million base cost step up and the big corporation tax advantage never occurred. Secondly, HMRC inquired into both of the group relief claims, so the grant of the lease to B64 and then the transfer of the lease to Tower 1. And HMRC denied group relief against both of these transfers. The taxpayer appealed and it wound up in the tribunal, and the taxpayer, Tower 1's main arguments was that, well, group relief should be available. And their secondary argument was that if you are going to deny group relief, then SDLT should only be charged on 30 million, the actual consideration we paid, and not 200 million, which is the value of the lease. HMRC thought it should be 200 million, and the tribunal agreed with them. So they rejected both of the taxpayers' arguments. Why did they do that? The first thing, and again, this is very high level, there's a lot of interesting stuff, I think, in this decision, is that, like a lot of tax reliefs, the SDLT group relief contains a TAR, a targeted anti-avoidance rule, and here's the tribunal's description of it. The effect of the TAR is to disallow group relief if, number one, the transaction on which SDLT would, but for any group relief, be chargeable is part of a scheme, agreement, or understanding, whether or not legally forcible, and two, a main purpose of that scheme, agreement, or understanding is avoiding a liability to tax. So two components there. Is this part of a scheme, agreement, or understanding? And what is the purpose of that scheme, agreement, or understanding? Well, first of all, the tribunal said this is all part of a single scheme, and this is something that was argued against by the taxpayer, but the tribunal held, well, no, this is part of a single scheme or arrangement, because it's part of giving effect to the tax planning. These are all crucial steps in it. And this is a quote from the tribunal: part of a single plan formulated before the transactions are effected, and in which the parties to each of the transactions are aware of that plan, are acting with the intention of giving effect to it. So everyone knew what the end result they were trying to achieve was. Everyone was working to that end result. Therefore, the transactions in which the lease was granted and in which the lease was hived up from B64 to Tower 1 were both part of an arrangement, a single scheme. And secondly, one of the main purposes was the avoidance of tax, and the tribunal talked about this at length, but they accept that your initial purposes and ultimately the reason why you went down this path of transferring to an SPV are perfectly valid and bona fide good reasons. But what happened was, instead of just doing this in a straightforward way, you adopted a much more convoluted structure in order to generate a tax benefit that you wouldn't have otherwise got, and then you worked to achieve it. You went through several iterations of a step plan to try and consolidate this tax benefit, and that is contrary to the TAR. So even though the sort of sine qua non, the original reason why you did all this, was perfectly valid, you chose to do it in a way which was designed to avoid tax or to create a tax advantage. And that pollutes all your other motives and ultimately allows HMRC to block group relief. So far, so good. Incidentally, the tribunal also said, it doesn't matter that you failed to get a tax advantage. What matters is that you tried. Secondly, why did the tribunal say it was 200 million? This is because in SDLT and LBTT, we have a rule that says a transfer into a connected company are charged at the higher of the market value of the asset you transfer, 200 million, or the actual consideration you pay, 30 million. Now, this rule has actually got various exclusions to it. It's got 3, and the transfer from B64 to Tower 1 appeared to fall into one of these exclusions, and that is an exclusion for distributions where the seller is a company. Now, if that exclusion applies, then the market value rule gets switched off, and SDLT is only charged on the actual consideration. But that exclusion then has an exclusion of its own, which says you cannot benefit from this exclusion if the person who is the seller, and that is B64 here, transferring the lease up, has claimed group relief in the last 3 years in respect of the property they transferred. As you'll have seen from the slides, B64 had claimed group relief on the grant of the lease to them. So therefore, the exclusion didn't apply and market value had to be used. That was, in a nutshell, the tribunal's reasoning. But next slide, please. This is where the everything happened on the same day point kind of adds an interesting twist to this. Because under the SDLT rules that were in force at the time, B64 couldn't actually claim group relief at all. It had submitted a group relief claim to HMRC, but as all the transactions happened on the same day, the grant of the lease to B64 and then the transfer of the lease by 64 to Tower 1 was a subsale. And under the subsale rules at the time, B64 eventually dropped out the picture. So it wasn't liable to SDLT. It wasn't really a buyer for SDLT purposes. It wasn't recognized as entering into a land transaction. So it wasn't required to submit a return. And in fact, there probably wasn't any basis for it to submit a return because at the time, subsales weren't, you didn't need to claim a relief. It just happened. And the tribunal said, well, we don't think this matters. The fact that group relief shouldn't have and probably couldn't have been claimed by B64 is irrelevant. What matters is the bare fact that they claimed it. So it's almost the administrative action of putting in a tax return with a group relief claim in it is what has prevented the exclusion from applying and has switched on the market value rule. So ultimately, the tribunal said you have to pay SDLT on 200 million. Another thing about this case is it throws up an interesting what if. I don't want to dwell on this, but again, the wording of TARs, as I said at the beginning, is really important. In the SDLT group relief TAR, tax means SDLT, income tax, CGT, and corporation tax, basically everything except IHT and VAT. What if this transaction had happened in Scotland, though? We have a group relief TAR with almost identical wording in it. But when you actually drill through the definitions and look at what words mean in the legislation, in an LBTT Act, the tax just means LBTT. And the group relief TAR in LBTT only applies to transactions which have a main purpose of avoiding LBTT. Well, in Scotland, so maybe the TAR wouldn't have applied. But in Scotland, we also have a GAR, a general anti-abuse rule, that could have picked up on this transaction. But again, it seems that it would have been ineffectual because it only applies to transactions which are intended to create an LBTT advantage. And again, arguably, one of the main motives in doing these transactions wasn't to save SDLT, it was to save corporation tax. So could you still have claimed group relief had this happened in Scotland? Possibly. So this is a very quick canter through what I think is a very interesting case. I think there are a number of lessons to be drawn from it. I think the main ones for present purposes are, be wary where you have a situation where you want to claim a relief, such as group relief, that there are TARs in there that can trip you up. They are motive-based. The precise wording of those matters. Even if your original reason for doing a transaction is a good one, it can be overridden by bad thoughts that happen later if you act on them. To activate these TARs, it's not necessary, it seems, to claim a tax advantage. All that needs to happen is you have a tax avoidance motive, even if you mess it up. So beware of mission creep. A final thing to note, this decision is being appealed to the upper tier tribunal, so it will be very interesting to me to see what comes out of it. I will mention this again in a moment where I think the appeal might go, but in the meantime, back to our poll question. What do you think would have been the fair result? So I'm not asking you what do you think the technically correct answer is, but what do you think is fair? Should Tower 1 have paid no SDLT? They should have got group relief because they never got the tax advantage. Should they pay 30 million? They should have got the exclusion from the market value rule and just paid it on the actual price. Or should they pay 200 million? You've got no sympathy for them. They knew what they were doing. Please take a moment to vote now, and we'll show the results at the end. Okay, I think that's probably long enough to give people to vote. I would say that my own view is that it should be the 30 million. I just think that the tribunal's arguments about the group relief claim are pretty bad. They are not very solid. And I actually think, or I would hope that in the appeal, that is the main point that the taxpayer raises. Not everyone agrees with me on this. A couple of people think they should have paid nothing. About half of you think it should have been the 200 million. And 42% thought 30 million. So I think most people feel that the tribunal reached the right decision there. It'll be interesting to see what happens on appeal. Now I'm going to pass over to Isobel, who's going to talk about transitional leases.
Thanks very much, Bob, for that interesting look at the SDLT case and what it might mean in LBTT terms. Transitional leases, what do we mean by transitional leases? We mean leases that were granted before the introduction of LBTT, i.e. SDLT leases or stamp duty leases, and also questions about agreements for lease and missives entered into before LBTT came in, or indeed tenants in occupation at 1st April 2015 with nothing in writing. Although those two are probably questions for another day. The LBTT regime was designed specifically to deal with Scottish leases, which are rather different from English leases in that they can be varied or extended much more easily. And that's why the LBTT regime doesn't require extra returns to be done for an LBTT lease when it is extended or varied, because LBTT has 3 yearly review returns, and those returns are used to capture the effect of extensions and variations. And the LBTT regime also, you estimate the rent when you do the initial return and then do the 3 yearly returns to true up the rent. We also have termination returns. So you can get a refund of LBTT when a lease is renounced. And the aim of all of this is to pay LBTT on the rent which was actually paid under the lease. This all works much better for pure LBTT leases than the SDLT regime did. SDLT focused on English leases, which are really a grant of an interest in land. So it's much more of a snapshot approach as compared to the LBTT regime. But what about leases that started off under SDLT or stamp duty? How do they fit into the LBTT regime? Well, it became obvious that there would need to be some sort of provisions to ensure that these transitional leases didn't escape LBTT altogether where that was appropriate, but also so that they were not taxed twice. And the bit of legislation which addresses this is the Land and Buildings Transaction Tax Transitional Provisions Scotland Order of 2014, which is a bit of a mouthful. It's generally called the Transitional Provisions Order. Revenue Scotland have recently revised their guidance dealing with this at LBTT 6050. And if you're dealing with a transitional lease, it's worth looking at the new guidance. So the Transitional Provisions Order deals with a number of aspects that relate to leases. And these are overlapping leases, which we'll come on to, situations where the assignation of a lease is treated as the grant of a new lease, variations of leases to increase the rent in the first 5 years, to treat those as the grant of a new LBTT lease, and variations of leases to extend the term or extend the premises let. So these are all items which are dealt with by the Transitional Provisions Order and affect these transitional leases. So to start off with extensions of the term of a lease, if you have an SDLT lease, which lasted for when it was granted 20 years, so it was granted on 1st November 2004 and terminates 31st October 2024, so that's 20 years. If it's formally extended for 10 years, then that 10-year extension is treated as a 10-year LBTT lease. So in the real world, we have a 30-year lease, but in LBTT land, we have a 10-year LBTT lease, and the other part of the lease continues to be an SDLT lease. Moving on to the next slide, the effective date of that lease is when the minute of variation to extend the term is signed. And that's when you have to do an LBTT return for this extension. And you return it as a 10-year LBTT lease. As you'll see from this diagram, the 10-year LBTT lease doesn't actually start until 2024. But when you're working out the LBTT, you don't get any discount to take into account the fact that you don't start paying rent under this LBTT lease for 2 years. So you treat it as an LBTT lease, which is effectively starting now. Because it's an LBTT lease, it has to abide by all the normal LBTT rules. So you have to do 3 yearly returns. And if the 30-year real lease is assigned, you have to deal with the assignation of the LBTT bit of it and do LBTT returns in the normal way for an assignation. So that the real world lease has been kind of split into two, and you have this notional LBTT lease, which is sticking on the end of the 20-year SDLT lease. It has to be a formal extension, by the way. If the SDLT lease is just continuing by tacit relocation, that doesn't trigger this treatment. So it has to actually be a formal extension. But if you have a formal extension, then it is treated as the grant of a new lease for LBTT. Moving on to the next part of the transitional provisions order. This is variations to increase the rent. And a variation to increase the rent, i.e. a variation which is outside the lease. It's not just a rent review provision, but an actual variation to increase the rent. That's also treated as the grant of a new LBTT lease, but only if it happens in the first 5 years. So this SDLT lease, which was granted on the 1st of November 2014, there was with a rent of 100,000. There was a variation to increase the rent on 1st November 2016. So that was within the first 5 years of the SDLT lease. And so it triggers this provision to treat it as an LBTT lease. And so what we have there in the real world, we have a lease which is for the 10 years with a rent partly 100, partly 150. In LBTT land, we've got a deemed LBTT lease for 8 years with a rent of 50,000. So the fact that it's only the first 5 years is really important, and there probably aren't going to be any more variations to increase the rent in the first 5 years of SDLT leases because we've passed the 5-year period. So what happens if there is an actual further variation to increase the rent? Well, it doesn't give rise to a new lease, a new LBT. The SDLT lease being varied doesn't give rise to the grant of a new lease because we're past the 5-year point. But the LBTT deemed lease, the rent in it has been varied as well, and that needs to be swept up in the next 3 yearly returns. But the rent of the real lease has gone up from 150 to 200,000. So how do you deal with that? Well, you don't just apportion it all to the deemed LBTT lease. You actually have to apportion the increase across both of them. So one way of doing it is just in accordance with the rent. You could adopt other approaches like floor area and whatnot, but the rent increase here is going to be apportioned. So the rent under the LBTT lease will go up to 66,667. The rent under the SDLT lease will go up to 133,333. There's no tax to pay on the SDLT lease increase, but the LBTT lease increased rent will be picked up in the next 3 yearly returns. So moving on to the next slide, how does the treatment work if you have both a variation to increase the rent and a variation to increase the term at the same time? This is an SDLT lease which was granted on 1st November 2014 and terminated on the same date. The rent, as before, the rent's 100,000. So here we have a variation to increase the rent to 150,000 and to increase the term by 10 years. So both of these factors increase, the increase in the rent and the increase in the term are treated as the grant of a new lease for LBTT, but the successive lease provisions apply to sort of join them together. So what you've got here is a grant of a new LBTT lease for 18 years with a rent of 50,000 for the first period and then 150,000 after that. So in the extension period, it's the whole of the rent, and up to the extended part, it's only 50,000. So as you can see, these transitional leases are really quite tricky to deal with. And of course, once you've got one of these deemed LBTT leases, you need to deal with that whenever you're doing an assignation, for example, of the SDLT of the real lease. If it was an SDLT lease to begin with, you need to find out whether it's been varied in the past to increase the rent or in the first 5 years, or increase the term. And when you're doing the assignation, you have to look at both the LBTT lease and the SDLT lease and deal with both of them in the assignation. Moving on to stamp duty leases. Are extensions of stamp duty leases subject to LBTT? The transitional provisions order itself doesn't specifically refer to stamp duty leases, only SDLT leases. And lots of people have argued that extensions of stamp duty leases are not caught by the transitional provisions, unless there's been a previous variation. And that's the basis on which a lot of people have been making returns in relation to stamp duty leases. Revenue Scotland's view has always been that extensions of stamp duty leases are subject to LBTT. In the technical bulletin back in October 2016, they made this point. Stamp duty leases varied after July 2004 are treated for LBTT as if they were the grant of a new lease. So right back at the beginning, Revenue Scotland said that extensions of stamp duty leases are subject to LBTT. The thing about stamp duty leases is that they were never really, extensions of stamp duty leases were never really covered by the SDLT legislation. There was a gap in the SDLT legislation, and the treatment of extensions was really just agreed by the Law Society of Scotland with HMRC, that we would deal with them as the grant of a new lease for SDLT, but that was never in the legislation. So it's not really properly dealt with in the transitional provisions order. But what Revenue Scotland say in their most recent guidance is the modern approach to statutory construction is to look at the purpose and interpret the language in a way which gives best effect to that purpose. And that applies to tax as well as anything else. So applying a purposive interpretation to the wording in Revenue Scotland's view means that stamp duty leases are subject to LBTT when they are extended. So are Revenue Scotland right about that? Who knows? But the intention is very clear that extensions of stamp duty leases are subject to LBTT. The wording really isn't that clear, but only a tribunal case about it would probably put the matter beyond doubt. Moving on to just a reminder that the tacit relocation of a stamp duty lease doesn't get treated in any event as the grant of a new lease. It's only if you have a formal extension. Moving on to assignations of leases and where that may be treated as the grant of a new lease. If you have a 10-year lease with 7 years to run, which is assigned from one tenant to another, that would normally, as you can see on the next slide, just end up being a lease treated for LBTT purposes as still a lease to the tenant 2, and the tenant 2 would pay LBTT on any premium, but would have to start doing 3 yearly returns and so on. If, however, the first lease was subject to a relief, sale and leaseback relief, group relief, charities relief, seeding relief, and so on. Then when it is assigned, it's actually treated as the grant of a new lease. So it's grant of a new lease with the rent of 100,000 a year, and the LBTT on that is 5,800. So that is a trap that you don't want to fall into. And the answer here is to really find out, to ask whether the lease, when it was granted, was subject to one of these reliefs. And the reason it applies to transitional leases is because this treatment applies whether the reliefs were originally LBTT reliefs or SDLT reliefs. The final thing in the transitional provisions order is overlapping leases, and that's where an old lease is renounced and a new lease is granted over the same premises, and the rent payable under the new lease is reduced by the amount payable under the old lease. And this overlapping leases point applies whether the old lease is an LBTT lease or an SDLT lease. With overlapping leases, you can get the relief, the overlap relief, for SDLT leases as well. As you can see, transitional leases are pretty difficult to deal with. I don't know if anyone has any questions either about the transitional leases or about the tower case and group relief, but this is an opportunity to raise questions now. I guess one question on the tower case, Bob, is really just whether Revenue Scotland are likely to follow some of the wording in the decision in looking at group relief claims generally.
I think they probably will. I think for Revenue Scotland, probably the biggest takeaway from that decision is that failure or success in achieving a tax planning advantage isn't relevant. I think also the other two things that will be of interest to Revenue Scotland are, in certain parts of LBTT, you know, we have this concept of arrangements, and the decision has some good sort of hallmarks about when things fall into arrangements, not necessarily telling you when you're out of an arrangement, but certainly when you're into an arrangement. And thirdly, I think that point about the market value rule exclusions when they don't apply because of group relief. I mean, I think that point is perhaps unlikely to arise again in practice. I think it's quite a niche point, but if it does, depending on how the appeal goes, I think that's something that would be of interest to them. But certainly the stuff around the concepts of arrangements, which we didn't talk about, and, you know, success or failure in tax planning will be of interest and use to them.
So it's certainly worth looking at. One final question we have about extensions of stamp duty or SDLT leases is tacit relocation. If a lease is tacit relocation followed by a formal extension, how does that work? And generally, when you have a lease which continues by tacit relocation and then is formally extended, the formal extension is sort of backdated to the termination of the original lease. And if that's what happens, then for LBTT purposes as well, the lease it's treated as the grant of a lease starting from the end date of the previous lease. The effective date will be when the minute of variation is signed, but the term will be sort of go backwards and take in the tacit relocation period so that LBTT ends up being paid on all of that. As we said, please do feel free to send us an email if you have any questions about any of this, and we'll be happy to answer them. Transitional leases are very hard, so please don't hesitate to ask questions after the seminar, and we'll be delighted to help. But thanks very much for your attendance this morning, and we hope you found it useful. Thank you.